You sell a stock for a loss, then buy it back a week later. You think you're locking in a sweet gain, but nope, the IRS says no, that is a wash sale. Let's break it down. A wash sale happens when you sell a security at a loss and then buy the same or substantially identical security within 30 days before or after the sale. That's a 61-day window, and you lose the tax write-off. So normally when you sell a stock at a loss, you get to deduct that loss. It reduces your income. It's called a capital loss deduction. That deduction can lower your taxes, either by offsetting capital gains or up to $3,000 a year against your income. So you can reduce your taxable income to do this. So if you take the hit, that could mean a smaller tax bill or even a fatter refund. But here's the catch. If you buy the same stock back or security back within 30 days before or after the sale, the IRS says you didn't really walk away, so there's no deduction for you. That loss is disallowed. You can't use it for this year. But it's not gone forever. They add the disallowed loss to your new cost basis. So when you finally sell it later, you'll get the tax write-off then, unless it's in an IRA, and then it's a whole world of shit. And it doesn't have to be the exact same stock. The IRS looks at substantially similar, identical securities, which could be buying a call, buying a right, buying a convertible, buying a warrant, buying a call. All of those things would trigger the wash sale. Or even if you sell a mutual fund and you buy back a substantially similar mutual fund, that would disallow it. So let's do an example. I sell 100 shares of ABC at $40 for a $10 loss. And then within 30 days, I buy the stock back at $35. So what happens is, if it's within 30 days, the IRS disallows the loss, and what they do is they add my loss to my cost basis. So if I rebought the stock back at $35 after a $10 loss, my new cost basis, I still paid $35, but now cost basis is now $45. I add the 10. So then when I sell the stock, I will make a gain or loss based on the $45, not where I really bought it. So remember, this only applies if you have a loss. If you have a gain, this doesn't apply. And the 30-day window is before and after the sale, and any substantially similar securities. You disallow the loss and you add it to the cost basis. You can take it later when you finally stay out of it. If you think this was helpful, please join me every Tuesday at night at 8 p.m. on the Tube of You under Capital Advantage Tutoring. I have a free live Q&A. I'll answer all your questions on the FINRA and NASA exams. So let's fucking go.